Welcome to Next to Madison, a podcast to help you live your best life. Welcome back to another episode of Next to Madison. Yes, I have been on the financial crypto kick. It is time to get rich, or at least try to get rich, or educate yourself to get rich. Speaking of getting rich, I'd like to remind everybody to please do me a favor and rate and subscribe to us on iTunes or Apple Podcasts now, and leave a review if you like it, just so we have some more feedback of what you guys are thinking and kind of what's helped. So make sure to do that. But we're going to go ahead and get into this. Now, our guest today is a guest that was on 3 episodes ago, episode 90. He's coming back solo this time because after that episode aired, the whole Reddit meme stock thing blew up and everybody wants to know how to get into the market, what to do. So we're just going to do like a rapid kind of, question and answer, not so rapid, but question and answer about stock advice. And hopefully you guys learned something great. So with that being said, John D'Agostino, welcome back to Next to Madison. How are you?
I'm great, Madison. And I'm not going to give financial advice, but I'm going to treat you like the friend you are. That if you came to me and said, "Hey, Johnny, I got some questions," or if I met you in a bar and you seem nice and I wanted to help, I'm going to give you the same advice I would give a family member or a close personal friend.
Okay, perfect. And you guys listening, you get the benefit of all this. So I first want to open up because the whole GameStop and AMC, and there were others that started on Reddit, which was the channel Wall Street Bets. That whole thing. Give us like your take on that, because I know you've done some TV appearances and then you've stopped.
Yeah, I stopped because it's kind of a topic you're not really allowed to be thoughtful about. It's generating so much populist anger that if you've got anything but an extremely pro-Reddit approach, you start getting death threats and things like that. But I'm going to assume your audience is not that type. So long and the short of it is, look, there's no question it was a fascinating, game-changing development, right? So it's not, look, short squeezes are not new. Meme stocks, meaning like stocks that are just fueled by nothing but really kind of excitement and interest and irrational exuberance or just exuberance. That's not new. But now we have the internet. Now we have this unbelievably efficient mechanism for producing exuberance. And what is new is this was the first time that it was able to work on this scale. We've had stock twits, which is a version of Twitter that trades. We've had this has been around for a long time. Yahoo Finance, message board. Like, this is not a new concept. It's just, wow, this was an old concept on steroids, right? That's the part that nobody figured. Nobody figured that you get 1 million people to spend $600 each in one direction. So it's called the first decentralized short squeeze. I'm not so sure about that because it happened on Reddit. Reddit was centralized. So, but it was a big thing, and it changes the game. And professional investors and hedge funds and allocators and big insurance companies, they're going to have to consider this going forward. I don't think it's going to happen all the time. I think this was a bit of a unicorn, but it could happen again, and it will happen again. And everybody has to understand that.
So what happened? How did the person that kind of started the whole kind of momentum behind GameStop, how did they find out how many shorts were out there? Where can you find that information?
It's on Bloomberg. It's available. It's under what's called level 2 information, so you have to pay extra for it. You probably wouldn't be able just to get it for the free version, but it's readily available. It's not a hard thing to find if you are willing to pay some money or just snoop around a bit. It's not difficult. All of this is public information. All of this is readily available.
Okay, so hedge funds are notoriously known for shorting stocks. That's kind of what they do.
And apparently being dicks, because I didn't realize there was so much hatred for hedge funds until I started studying this. I gotta be honest, I don't get it. But yeah, I mean, they are hated.
Well, yeah, I think it's because they're able to take such a mass amount and kind of manipulate the market in their favor. And what we realized when people kind of pushed back was that all of a sudden they had competition. And people were like, well, these fuckers with their yachts and their Maserati.
But here's the weird thing about that. So in my world, and I don't work for a hedge fund, but I work with hedge funds.
Yeah.
My job is actually I protect the investors in hedge funds. I sit on the boards of directors of these hedge funds and make sure they're doing what they say they'll do for the investors. So I guess I'm kind of a dick. I'm not sure where that puts me, but I'm protecting the investors. I try at least. But here's the funny thing. So in my world, a lot of people don't like hedge funds because they don't manipulate the market or they can't manipulate it. Hedge funds actually overall have performed horribly. 97% of hedge funds don't beat just an index, a Vanguard index you can invest in. So it's funny because coming from my world, it's like I knew people didn't like hedge funds because they were not able to manipulate the market to their advantage. But some of them still got paid a lot of money, and that rubs people the wrong way. So when I started studying GameStop and I started reading these threads, and all these people were saying these hedge funds manipulate the market, I'm thinking, God, they wish they could. Like they absolutely wish they could manipulate the market. So no, they don't. They really can't manipulate the market, but they do. Yeah, they definitely do some shady stuff. And the worst thing they're really guilty of is just horrible PR. Hedge funds are just horrific at presenting their arguments to the public, and so the net result is everybody hates them. And it is what it is. You're not gonna. I have these calls with hedge funds all the time with like, we have to figure out a way to get people to like us. I'm like, dude, like done. Like ship has sailed. Like I don't care how much money you could pull a bus full of puppies from a burning lava pit, and people will still hate you. Like move on.
Yeah, no, understandable. But here's the thing, because the common man can't get into, or woman can't get into a hedge fund.
They shouldn't. Most lose money. It's good for them that they don't.
So understand that, you people understand that. So yeah,
that's the big dirty secret. But yes, for the 3% that do consistently beat the market, you're right. They can't get in. Now that's not the hedge fund's fault. That's our country has decided, and this is maybe a different conversation, but our country's decided to measure sophistication by wealth. Not every country does this. Other countries have what's called an opt-in model, like Switzerland, for example, where they say, look, if you want to be treated like a sophisticated investor and get access to all this crazy shit, you have to basically sign something that says, treat me as sophisticated. Now, what that means, Madison, is if you get fucked over, the protections are lower. The one advantage of being a retail investor is generally the courts are much more sympathetic when you lose your money. When you are deemed a sophisticated or accredited investor that allows you access to hedge funds, in this country it's by wealth, in other countries it's opt-in. If you get fucked over, the courts are much less sympathetic to you. So there is a bit of a give and take.
Okay, so no, that's well said. So here's the thing, I'm really into like investing and all that stuff, and sometimes I'll have friends text me, and some of you out there listening might have this as well, and they'll say, check out this stock. What is your advice when somebody sends you a ticker symbol that you should check out before you invest your money, and how much should you invest?
So, all right. So again, I'm not giving financial advice. And the key, and I don't want to be one of these guys who doesn't give a direct answer. But the key is you got to start with what your goals are. Like that's the bottom line, right? So I think what you're talking about, which is like placing bets, a random flyer on a stock a buddy suggests. In general, the safe advice is don't do it. Like the probability that stock is going to be a winner compared to just investing in the index is really, really low. Now that being said, and again, I'm not a financial advisor, but I think in general, if you're my friend, we've known each other for a really long time, and I know you, and I know you're a pretty conservative person. You're not flashy, you don't spend tons of money, and I'm going to ascertain based on that while we all want to be rich, you don't require a tremendous amount of short-term income to pay your rent and live your life, because you live a reasonable and in my opinion, a smart way of budgeting your life. So because I know that about you, I would say, look, Madison, you don't need to shoot for the moon to get your basic needs met. So let's create an investment policy that first satisfies that. Let's get you an income stream, that gets your basic shit down. You don't have to be paying your rent. Let's supplement your working income with that. Then, look, everybody should have some shoot the moon money. Everybody should have a part of their portfolio that could go up 1,000 times, right? Otherwise, what's life all about, right? We should all have that. Now, what percentage that is, most traditional finance would say it should be no more than 5%. But if we sit down and you say, look, John, I I will be happy to live I'm living in a 2-bedroom now or a 1-bedroom now, and I'm happy to go down to a studio or move back in with my parents, but I want a fucking Mercedes. I want that money. I'm willing to take the risk to get there. Then guess what? Maybe we bump that up to 10, 15, 25%. But you've made a conscious decision to do that. And then maybe we concentrate, meaning we put a lot of money into one thing, whether it's cryptocurrency or a penny stock or whatever. Something that has a chance in hell of going up 1,000 times. But you've made a conscious decision, a thoughtful decision to take that risk. That's okay. You're an adult. And then you can deal with the consequences.
Yeah, because it's interesting, because it's like, where should somebody go? But also, that's great advice. But if somebody was interested, where's a good place they should go to research the company? Because what was it, Warren Buffett? You shouldn't invest in something you don't understand. You should understand what the company does.
Absolutely. And now look, that flies in the face of the way meme stocks, most of the things you've read about that have gained a lot of money, people invested in without doing any research. So I agree with you. You should do your research. The wonderful thing now is there's tremendous free resources for doing research on public companies, right? There's Yahoo Finance, there's Google Finance, Bloomberg has amazing resources. So there's no shortage of credible resources. I would not suggest doing your research on places like Reddit, but I would suggest looking at places like Reddit, because one element of research is what's called money flows.
Okay.
So money flows is basically, it doesn't matter what the fundamentals are. It just matters if there's supply-demand imbalances. So you can bet your ass that even the most rigorous fundamental hedge funds that do enormous research and are able to access research better than you or I, because they'll spend tens of thousands of dollars hiring industry experts. So let's say they're looking at a company that produces heart valves. They'll go pay what are called expert networks, and they'll talk to a heart surgeon who uses these heart valves, and they'll have a 2-hour conversation and pay that guy $1,000 or $2,000 to give them, I wouldn't call it inside information, but better information on heart valves. Now, unless you or I know a heart surgeon who would do it for free, we probably can't do that. So there's asymmetric information, but to get a basic read on a company or a commodity or even a crypto is not hard. But now what we have to do is incorporate social media, because money flows can make all of that fundamental stuff completely moot.
Right. No, that absolutely makes sense. Yep. So yeah, it is important to look at kind of what the company is doing with this happened to me yesterday.
Go to Yahoo Finance. Put the ticker in. You'll see the links. You'll see financials. Check out their balance sheet. Check out their income statement. There are tutorials as to how to read a balance sheet and income statement, so you know what to look for. If you're putting your money into this, take the time to educate yourself. Khan Academy has amazing free courses on basic finance. And it's not that hard. Don't let people make you think it's really hard. They do that to obfuscate and sort of keep people and get you to pay them a fee for managing your money. You can understand, you can learn how to do basic research on a company.
Yeah, and this happened to me yesterday. I was sitting in the dermatologist, and I get a text from a friend who says, "Oh, you should check out this ticker symbol." And it was $1.62 when I opened it up, and it was like 9:32 in the morning. The market had just opened, and I looked at it, and I said, some gut feeling said, I trust this guy. So I Googled the company really quick, and I said, "Oh, they're coming out with a COVID skin test. That sounds like a great idea. Nobody wants to be anal fucked or mind fucked with that Schwab." So I said, I believe in this. This is great. So I decided, I'm like, you know what? I don't know much about it. So right on the spot, I was like, fuck it. I'll just buy 100 shares. Everyone can afford to lose $162, right? Well, sure damn enough. That thing is cranking up. So
that's great.
That was a risk, but I was willing to take that because it was only $162.
Okay, but this is very important. So you did two things in that statement. One I love, one I don't love.
Okay.
Well, I'm assuming the second part I don't love it. Let me make sure I don't. I'm gonna be mean to you for a second, because I don't think you're saying this, but I'm gonna pretend you are, because this is what I don't. What I love is you did something really smart there. You said, you know what? I know I'm not doing any research. I know this is just basically I'm throwing the roulette dice here, and so I will size the trade accordingly to my risk appetite. Brilliant. Love it. That's great. Other people might have a different risk appetite. They may say, I want to be rich, and I don't care if I lose everything, and I'm all in on these penny stocks based on no research. Again, I don't think that's a good idea, but you did the analysis, which is great. Then the second thing you said is because the price went up, you kind of got excited and said, well, then maybe I'm implying this, maybe I'm not right, but you kind of insinuated that this might be a good thing to do because the price went up. This is a major, major problem, right? So let's talk about gambling in Vegas. The best gamblers know there's no such thing as a hot hand or a hot table. The worst gamblers believe in things like hot hands, meaning if so I love craps. Craps is my favorite game. It's social, it's fun, everybody wins.
Yeah.
I've rolled, so craps, you want to roll what's called a point, which is you re-roll the number that you rolled initially. And when you roll a point, so if I roll 4 initially, if I roll 4 again, everyone doubles their money. Yeah. And I get to keep going until I roll craps. I roll a 7. So sometimes people get a hot hand where they just keep rolling points. I rolled one time 11 points in a row.
Wow.
And what happens is the table goes, you could double your money 11 times, right? So $100 becomes like 30,000. So it's exciting, but everyone gets excited. Everyone gets crazy. The crowd builds. People start screaming, he's got a hot hand. And people run over and put money down. Very, very stupid. Okay. There's no statistical difference between my 4th point and my 3rd point. The probability of a crap occurring does not change based on how many points I've rolled. It's dumb fucking luck. So stupid gamblers believe in hot hands. So just because your portfolio is going up doesn't mean you deployed the right strategy.
True, okay? A lot of it's luck.
A lot of it is luck. So if it's gone up, that's great. That's wonderful. Take advantage of that by taking some profit off the table. Again, depending on your risk appetite. Because remember, if you don't take money off the table, it's the same as reinvesting. Right? So if you look at that stock going up and say, ooh, I'm glad it went up, but it's really risky. I don't want to put any more money into it. Every moment you don't sell, you're putting more money into it. You have to think of it the same way.
Interesting.
So what I do, the way I gamble, is if I sit down with my money, at the craps table, I sit down with a fixed amount of money that I'm willing to lose. And if I start winning, if I'm lucky enough to start winning, I just take chips off the table and put it in my pocket. Once I've got about a 20% return, so if I start with $100, once I have 120 in my pocket, whatever's on the table, fucking let loose. Go nuts. Have fun, right? Have a blast, because I earned my 20% return. But letting it ride is what the casinos want you to do and what bad investors do.
So that leads me to my next question. People get into these stocks they hear about, and like what happened with GameStop, they didn't get out. When do you know when to properly get out? Yeah.
Again, it's a personal decision. It's what are your aspirations? What is your risk tolerance? So I, have been in markets for a very long time. A 20% return in a couple of days or even a month is damn good. I know cryptocurrency folks would disagree with me, and I get it. Every asset class is different. But you think about if I was able to replicate this return over a period of time, would I be happy with my life? And if I'm able to replicate a 20% return consistently for the rest of my life, I'll be doing pretty well. That's a great life. It's for what I want, based on how much money I have and based on the calculation of what I want to be. It's not going to buy me a private jet, but it's going to pay for my kids' college. It's going to give me a nice house where I want to live, and it'll allow me to lead a life that I can enjoy and be happy with. So that's my bogey. And so I view my life in 20% increments. So if I'm up 20%, take a little bit off the table. Up another 20%, take a little more off the table, and incrementally go higher. And I'm willing to, obviously I've made less, if it keeps screaming up, I've made less money than I would have let it all in.
Yeah.
But over time, I think I'll be happier doing that, because avoiding losses is more important than maximizing gains. If you're down 10%, you need to be up 20 to get back to break even. Right. So the key is to try to minimize your losses. I'd rather minimize losses than eke out every cent of that gain.
That makes sense. So it's very well said. So we'll go back to the GameStop thing for a second.
Yep.
So the stock just shot up. It was thousands and thousands of percent.
1,700% in the course of a week.
So if all those people had gotten out, they would have been very well off. Much more off than they were.
Right, but they couldn't all get out because there was no liquidity to all get out. Right, that's the thing. So just because the ticker says GameStop's worth $500 a share, it's only worth $500 a share because people weren't selling. If everybody started to liquidate and take their earnings, the stock would have even more quickly reset now. So that's another big thing to remember, is your mark-to-market value, what the screen says you're worth, is not what you're worth.
Is what somebody's willing to take it
Yeah,
off.
you can't pay your rent in GameStop stock. You have to pay it in dollars. So you're worth the dollar value. Now, again, for a liquid stock like IBM, if your portfolio value says $10,000, you're probably getting $10,000, minus your brokerage fee or whatever. But if you're playing around in these penny stocks or these meme stocks, just understand you may not be worth what your portfolio says you're worth, in dollars at least.
Well,
Does that make sense?
Yeah, absolutely.
Yep.
Totally. But the thing is, I think a lot of these people didn't get out because if you went to the Reddit group, Wall Street Bets, they were saying, hold. The longer we hold, they can't do their short sells and their fucked. So everyone kept holding and holding. And then Robinhood came in and restricted it. So what kind of went on there? Like, they prevented buying. So
I mean, I'm sympathetic. I'm sympathetic to the folks who believe that look, if it wasn't Robinhood, it would have been something else. That was not sustainable. So, but that being said, I am sympathetic to those people. I mean, a little bit of it was greed. Let's be honest, right? It was there were definitely people there who were. I don't think you should trade out of spite, quite frankly. I mean, you should not, invest for spite. This notion that they were doing it to destroy Melvin Capital. I don't think anyone knew who Melvin Capital was. I'm baffled by the hatred of these funds. I mean, the first thing is they didn't destroy Melvin Capital. They destroyed Melvin Capital's investors. Melvin Capital's investors, well, I don't know for a fact, but large hedge fund investors include pension funds. So, this notion that this was some moral crusade, I find very odd. A million Redditors with $600 each could change the world in very material ways. They could go buy out student debt. They could go buy, last year there were hedge funds shorting St. Jude Children's Research Hospital. They could have gone and blown those guys up, those bastards. But this notion that this was a moral crusade, I'm a little bit skeptical about, but I'll take it at face value. I think if people, believe they were doing something good and destroying the financial system, I don't think they were effective. This was not the way to do it, but fine, that's great. But they were not they were not going to get out. So yeah, I mean, I think the whole hodl thing in crypto and the whole diamond hands thing, you got to be really careful about that. That's what Ponzi schemers do to keep people in the game. The main guy, like the guy who's credited as being the guy for GameStop, he did an interview and he seems like a nice guy and he was very honest. He said, "Oh, this is amazing. I'm up $20 million and I get to build my family." He's a runner and he was like, "I'm going to build my family. I'm going to build a racetrack, my own indoor racetrack." Well, you can't do that with stock. So obviously he was planning on selling because obviously he wanted money to build a racetrack.
Right.
So I don't like the whole diamond hands thing. That gets scarily into Ponzi scheme territory. And so that's not an investment. You don't hold an investment forever.
So here's the next question. The new administration said they're going to pass an additional stimulus, which will be $1,400, little more than double. What do you think is going to happen then?
Well, again, I think it's going to be hard to replicate this because there's two ways of looking at this. One is that this was like the guy credited with starting is like he was a genius who managed to find the perfect trade. I read his thesis.
His name was Deep Fucking Value.
Yeah. So I read his trade thesis. It was really simplistic. It wasn't incorrect. He just looked up the short value and said, "This thing is really heavily shorted. We can squeeze it." There's a lot of stocks like that. I think I'm more a believer in chaos theory. I think just a lot of shit was thrown against the wall. This one just kind of randomly rose up and then it just built upon itself. Yeah. So the chances of that happening again, I think, are pretty low because people are very chaotic. And the problem with decentralization is it's decentralized, meaning it's hard to get people to agree on one thing. So look, silver, there was an attempt to do this with silver. It failed miserably. So I think it's unlikely. And by the way, now all the hedge funds have learned the lesson. So they're monitoring all the boards and the exchanges. I feel a little bad for Robinhood because the reality is Robinhood had no choice. I mean, all that trading activity resulted in them having to post higher margins. They had to slow things down. And again, that's not, I know it seems unfair, but that's what happens all the time. This is not a new thing that crazy trading in a stock causes. The exchanges have things called circuit breakers. They have rules written in that when stocks move too much in certain directions, you got to shut things down to get everyone a chance to calm down. So I get that the Reddit traders feel this was unfairly targeting them. And I'm not saying some of that didn't happen. I'm sure some of it did. But the notion that a stock that's trading out of control without any underlying fundamentals would be slowed down or halted by a broker or an exchange, it's not a new concept.
Right. So I think the thing, correct me if I'm wrong, that was irritating is they shut off the retail investors, but the banks and the hedge funds could still go in and short it and buy it.
I don't know that for a fact. I don't know that, Robinhood was the one who ran into problems, and Robinhood, is predominantly retail. So I think the net effect was that they cut off, but I don't believe it was retail isn't allowed to trade, larger investors are. It was, you've got to be able to post margin to trade, and the brokerage firm that most retail was using was unable to post that margin. So I don't disagree that this was done in a horribly ham-fisted manner. I don't disagree that the net result was it gave a breather to the funds who got caught short and allowed them to lower their short position. So again, I'm not arguing that this was fair, and I think it's being looked at right now. The DOJ is investigating, the SEC is going to be investigating, and so my gut tells me the takeaway is going to be that this was the net result was unfair. What I question is whether or not this was designed. On the flip side, Matt, is you have to understand the reason. Look, you can't have your cake and eat it too. So the reason that these retail folks have access to the market is because there are cheap resources like Robinhood. But there's a cost to working with a cheap resource like Robinhood, which is they're more susceptible to margin requirements. So again, it's unfair, but I don't get the same privilege of trading privileges as someone with $100 million account gets. That's just a reality.
Okay.
So if you're happy that you with $10 can lever up as a retail trader, lever up and trade for free 15 times and get access to all that exposure, you've got to understand there's a cost associated with that.
Of course, yeah. There's no free lunch, as they say, right?
But look, it wasn't fair. There are elements of it that were not fair, and I think there will be an examination of that. I think there'll be some rule changes around that.
Right. I mean, as there should be, but I think it's just the most important thing is making it fair for everybody. But also you got to protect people too, and that's what we're going to switch into options, because why shouldn't somebody fuck with options? To be honest, you can.
There's no reason why you shouldn't.
Ass.
Say again? What's that?
You can really lose your ass.
Absolutely. They can go infinitely negative. I mean, this poor kid who killed himself because he misread his he didn't read both sides of the trade, or he wasn't presented. We'll see. There's a lawsuit going on right now, but whatever, he wasn't aware that there were two sides to his option trade. And he saw one leg and not the other, and he saw he was down 700,000 or whatever, and he didn't see the other side. He was up like 690, or I'm not sure the exact numbers, but horrible. Yeah, look, why shouldn't you trade options? I'm not saying you shouldn't. Basic option strategies can be really effective. If you own a stock and you like the stock and you want to generate income from it, you can sell calls against the stock, and then the worst case scenario is your stock, the value goes up and it gets called away. So you've lost some of the upside, but you're protected on the downside. You've earned some income. There are basic strategies that are fine. But yeah, when you start getting into some of the stuff that the hedge funds do, it can get really complicated. And options are what we call asymmetric assets, meaning they don't behave normally. They move around in weird ways that are difficult to predict. And even if you're like super, super smart and understand Black-Scholes, understand how to model out option theory, they still behave very oddly. And so anything that behaves oddly, anything that has implicit leverage, options have, so that when we think about leverage or margin, it's I have $10 I want to trade and I borrow 10, right? So I'm 2x levered or 1x levered or 2x, however you want to say it. That's what I call explicit leverage. Just you've borrowed money, just like from the bank or anything. There's also something called implicit leverage. When you buy an option or a future or derivatives, you only pay a percentage of what your exposure is. And so by definition, you're getting leverage. So if you're getting $100 of futures exposure, you only have to put up about $5. So you've got meaningful leverage on that position. So if you borrow on top of that, you got leverage on top of leverage. And what leverage does is it exacerbates upside. So if the thing moves 1, you can make 10, which is great. It also exacerbates the downside. And the way things work with options is when it moves down 1 and your value goes down 10, what kills you is the margin call.
Yeah.
Right? You can't have diamond hands if your bank is saying, send me another $20 in margin, or I'm blowing you out. I'm selling your position. That's what kills everyone. Every trader who's blown up in the ever has always said, if I just had more time, if I just give me more time, a little more margin, I could do it. It's like a drug addict, begging you for more time to pay back their bill. But that's how it works, and that's Robinhood effectively got that call from the DTC, from the clearing, saying you got to pony up. You need more margin if you want to do all this stuff.
Yeah. So no, that makes sense. But yeah, it was something that, so many people were conflicted on. But it is interesting, you were one of them where you guys went on, CNBC, and then, of course, were unfairly treated when you were just trying to talk about it. I mean, it's a very heated.
Yeah, I mean, it's very personal and political, and this notion. Look, we can reorganize this country. We've made a decision in this country that we want to protect retail investors, and by protecting, we want to try to limit their exposure to investments that have a high probability of harming them. And we've made the assertion that the way to do that is by wealth. Now, again, other countries do it differently. Maybe there's a zeitgeist in this country. We're going to re-examine that. But what I would suggest is that people be careful about what they wish for. You hear this conversation? Ever heard the term financial inclusion?
I have, but go into it.
So the basic idea is that there are all these people in the world, billions, especially in poor countries, that are unbanked or underbanked. They're not in the modern banking system. They don't have bank accounts. They can't get credit, and it's a problem because credit can be a bad thing, but it can be a good thing. How many people have changed their lives by borrowing money and investing and doing well? Yeah. So financial inclusion is this idea that we got to get all those people into the modern economic system. Now, put aside for a second crypto because that seeks to change it, but the basic tenets of that are the same. So we got to get these people in the game. We got to get them understanding what interest is and be able to use credit wisely and give them the opportunities we all have. Financial inclusion. It's a wonderful concept in theory. There's something called I'm tired, long day. Microloans, so microfinance, where this really wonderful idea, somebody won a Nobel Prize about it. We're going to go to the poorest parts of the world. We're going to give $5 loans to women in sub-Saharan Africa so they can start their own little mini business. They can buy $5 worth of product and sell milk, whatever it is, right? So in theory, an amazing concept, Madison, wonderful. You look at the history of what happened with microfinance, it's horrific. Predatory loans started being given. There were villages in India where men set themselves on fire en masse because there's no concept of bankruptcy there. If you lose your honor, you can't pay back a debt, you kill yourself. And so it can be horribly abused. So my point is, and I made this comment recently at a crypto conference, everyone got mad at me. If you're gonna open the floodgates, if you're really gonna go out there and somebody who's never had a bank account in their life, you're gonna integrate them into the modern financial system. If all you're doing is pushing out the same shitty product that's been designed for a cynical banked customer base, who maybe is wise enough to know to avoid the crappy shit, if you're just going to onboard these people into that shitty cesspool of product, you're not helping anyone. You're releasing the wolves on lambs, and it's not moral, it's amoral, it's immoral. Sorry. And so this notion that we should just open the floodgates, I was on this panel recently, someone said, well, how can we not get, these people should have access to venture capital investments. And I'm like, dude, 98% of companies fail. So you're telling me that the poor woman in Ghana with 5 kids, she needs food, water, and medical care, not access to shitty VC investments, right? Yeah. So let's be thoughtful about what we mean by this. Just a system where we just like open the floodgates and let every person invest in anything they want sounds great on paper, but I don't know. What do you think? How do you think that would turn out?
No, I agree with you. It's unfortunate that we don't have financial education,
Yeah,
integrated into the
yeah,
education system, because, and it's very
yeah.
unfortunate, because money is what we need to exchange, right? And it's what we
Yeah.
need to live. And so why aren't we educating people more? And in all countries, you
Check
know?
out a company called Napkin Finance. A friend of mine from business school, Tina Hay, she started it. And the idea is that you can explain all these financial concepts in the back of a cocktail napkin. So she writes
Oh, I love
books.
that.
Yeah, you should try to get her on your show. She's a big shot now, but
Yeah, I would love that.
Tina Hay, she's great. I went to Harvard with her, and that's what she does. I agree with you. Financial education is crucial, but there's this notion that Madison. The problem is this notion now of anti-expert. So anyone who's a proclaimed expert in something is hated on because there's this perception that they're trying to keep that information to themselves. So I struggle with the financial inclusion argument. I struggle with the opening up complex investments to retail investor argument. It's this libertarian ideal, which I understand in principle, but it reminds me of the drug legalization argument. Like I'm all in favor of like legalizing marijuana, maybe even like some of the other drugs, but then you get to like crystal meth and you're like,
Yeah.
I'm not so sure. I'm not so sure. Yeah, like the libertarian purist argument kind of breaks down at the extreme edges.
Yeah.
Same thing with this. I don't know if I want my mother getting cold called and being sold, straddles, option complexes. So
Yeah. So we have to be careful with that, because there's a lot of, elderly crime where they go and
yeah,
call them up, and
yeah.
not to report too much about it.
And,
But
and here's the other problem too, Madison. Sorry, but this is really, so the real problem is this. Remember I said there's no such thing as a hot table?
yeah.
The request to change these rules happened during hot tables. What I mean by that is we're in a hot table right now where everything's going up. Everybody, the market's going up, bubbles on top of bubbles on top of bubbles. That's the worst time to change those rules, because by the time the influx happens, the correction happens. And then everyone gets, all upset and saying claims they were robbed. So the worst time to double down is during a period of frothy exuberance. And so like letting everyone into the game now, let's let people, if they want to be in the game, if we want to change all the rules, let's do it during a less frothy time.
Yeah. So that leads me to my next piece of advice that I want from you. The market is so hot right now. The Fed rates low, printing money like crazy. It just doesn't seem real, right? It's just this like, it's like this banana republic. So my thought was, well, you know what? I'm gonna hang on to most of my cash right now. The new money that's coming.
Not a bad idea.
And I'm gonna wait for this shit show to fucking bottom out.
Yep.
And then I'm gonna go in. Good idea? Because I feel like I'm buying it
Yeah.
at a time high.
Well, yes, in theory, look, having you can have too much cash too. So having some cash set aside and increasing that proportion as the markets you're invested in get frothier and frothier is generally a good idea, right? Over time, the best investors will do better by keeping some dry powder as things go up. It's no different from taking my chips off the table, right? It's the same concept, right? So yeah, you will do better over time doing that. At the same time, you don't want to try to time things too much. You don't want to stay like 90% in cash, because again, you're going to miss out on lots of those gains, and that's going to be problematic over time. So I think again, it's about going back to, I'm sorry to keep doing this, but what is your risk tolerance? And so knowing as I know you, I'm telling you, yes, that's a good idea for you. As things get frothier and frothier, take, again, not too fast, but like, pick a pattern. You should dollar cost average in and dollar cost average out. You know what that means? Dollar cost averaging. You know that, right? So dollar cost averaging in is smart, but dollar cost averaging out is really smart, right? Pick fixed increments, right? I have in my mind, every time the S&P goes up a certain percentage, I take a certain percentage out, and my ratio is based on my risk tolerance. But the key is to stick with it.
Okay.
Good or bad, like stick to your plan. Don't deviate, be consistent over time, and you should produce, the desired risk-adjusted return that you're looking for.
And when you say take it out, where are you putting it next?
Mostly cash. Maybe munis, earn a little bit extra here and there. Remember, time is super, super powerful. The difference between, 1% compounded over 20 years and 1.01% compounded over 20 years is like a car.
I know.
It means a lot. Yeah. So I keep it, cash. I like some of this private debt stuff where there's all these ways now you can invest money and buy student loans, things like that, and get paid. These are not like nothing that's going to write home about, 4% return, things like that, anything to juice up. But again, all those carry incremental risk, but I'm comfortable with that risk. But having dry powder, having cash in the bank during frothy periods is a very smart move.
Yeah, absolutely. So if somebody is saving for a down payment on a home or to pay cash for a home, what is a good safe investment, short-term investment?
Right. Yeah. Right now, there's nothing. Right now, it's 6-month CDs. If you don't need it in 6 months, there's not much right now. Interest rates there's nothing safe that pays anything right now. So locking it up for 6 months in a CD is fine if you don't need it, but you're going to get a very marginal spread to what your checking account's going to pay. But again, it matters over time. Like, be honest about how much cash you need. Have enough. Have your nest egg. Be ready. And we never know what's going to happen. But like, if you're somebody who, has a sick relative or a sick spouse or something, there's a higher probability you'll need cash sooner. So you should have a little bit more cash there. If you're not, doesn't mean, God forbid, doesn't mean something can't happen. But maybe you can lock some more stuff up in CDs for longer. But just be reasonable. Like, the rule of thumb is usually 3 months living expenses, right? Have that sort of like just ready, sitting in a checking account in cash. But right now you're not gonna. Right now, the use of that cash is the opportunity cost, meaning being ready when the market corrects, and then dollar cost averaging into that correction. Never try to top ticket. Never try to bottom ticket. Meaning, don't like hang around and wait, because generally when the severity of a correction, that's the severity of the increase of the recovery. So just, again, be consistent. Dollar cost average. Okay, I'm gonna see when the market corrects 10-15%. I'm gonna take 10% of my money and buy in. Corrects another 10%, another 10%. Model it out that way. If the market's down 90%, we're all fucked. We're all going to be hitting each other with spears and
it'll eventually go up, right?
Exactly. You have to believe that. You got to believe that. If you don't believe that, if you don't believe it's ever going to go back up, or you don't believe we're going to recover, then really you should be buying, seeds, barbed wire, and bullets, because that's all that's going to matter. I don't understand people who think the world's going to end and they buy gold or Bitcoin. If you really believe the world's going to end, you should buy bullets, seeds, and barbed wire. That's at least if you're a prepper, be consistent.
Yeah.
What's that? Dried food. Yeah.
Yeah.
Well, no, but if I have a gun and you have food, guess what? I have your food. So I'll take bullets over food.
That is true. That makes sense. But yeah, so when I hear 90%, I'm like, time to get in. You know what I mean? So it's all about your thought process. And I always have to remind people, you don't lose if you don't sell. So people are like, I'm so fucking broke.
Well, it depends. If it's a shitty asset, I'll disagree with a little bit. If it's a solid asset that you believe in longer term, then yes. But if it's a shitty asset that's not going to recover, it's a non-productive asset, it's a true bubble. There's productive and there's inert bubbles. Productive bubbles build a foundation that they recover from. The first internet bubble, we got PayPal, Google, right? We got these amazing companies with a foundation. So if you stayed in there, you rode that back up. But if you invested in Pets.com, Madison, you lost when you didn't sell, because you could have, let's say Pets.com went down 90%, you didn't sell. You could have taken that 10%, reinvested it into Google, and you've lost that. So you do lose when you don't sell if it's an inert bubble, if it's a worthless asset. But if you've invested in good things with good fundamentals and you believe in them, then another way of putting what you're saying is, don't be scared by volatility.
Yeah.
Because over time, when you look back at the chart, the volatility, that big wave starts to compress. If you just narrow in on Amazon in one period, it looks scary. You pull back, it looks like this beautiful thing that buys you houses.
Right. And it has for a lot of people, especially Tesla this year. Oh my God. My dad's CPA, he's getting calls like crazy. I gotta update my quarterly estimates. I'm super, super rich now. And I'm like, oh,
yeah,
Tesla. So good.
Yeah, from Tesla, yeah. And and some people believe in concentration too, like Charlie Munger, Warren Buffett's partner. He had a great line. He says, "Why would I put money into my 10th best idea?" So
that's true. So I know we have to wrap up soon,
yeah.
but I do want to ask this question, okay?
Sure.
Because everybody, well, not everybody, but when a company goes public and it lists on the stock exchange, it's called an IPO. And then there's the pre-IPO shares, which are for the accredited, sophisticated investors that have access to these. But now some companies, Spotify did it, are going direct to market. Is it a good idea, and I'm talking about Coinbase here, is going direct to market, okay? To buy on the day it lists?
So I can't speak about Coinbase.
So other companies.
Sorry, I'm conflicted. Look, in general, really hot companies coming out the gate, the IPOs tend to pop. That's why they're so valuable, and that's why the big investment banks that get pre-IPO allocations or get IPO allocations, they dole them out to their best customers. There's no question. That is one area where I think we do need financial inclusion. I think we need to spread the wealth there a little bit more, and not consign the retail public to getting the dregs of the secondary market trades. So yeah, if you can get in, again, the high value, the highly anticipated IPOs, they do tend to pop. And so, there is a theory that, there's a lower risk level, higher risk adjusted return to investing in high quality, IPOs at the listing price. Over time, you probably would have done well doing that. There are hedge funds that's their strategy. They just get allocations for hot IPOs, and that's what they trade. They tend to be few and far between, so you can't usually make a lot of money off of it. But yes, they tend to do well in the first couple of days of trading. Again, don't get greedy, because there also tends to be a correction after some period of time. The exuberance wears off as people take their profits. People don't assume the market has your back. They're not there to have your back. They're there to make a profit. If they have to make it at your expense, because again, when you buy in, you've sold to someone. Right? Yeah. Every sale, every buy has a sell. That means somebody else does not want to be in that stock. So, again, have your number, have your bogey. I will be happy with this amount of return. Don't make that number ridiculous. And if you hit that return, for God's sakes, take some off the table. Put some in your pocket. And then let it ride. Then let the remainder ride. But don't fall for the hot hand fallacy.
Okay. So why do you think that more companies are starting to do direct to market versus IPO?
Because they can brand themselves, and they've got millions and millions of Twitter followers. They've got what does an underwriter do? An underwriter goes out and finds people who want to buy your stock and gets them excited about your company. If you've got 100 million Twitter followers, Elon Musk, and you can do it, you are a better brand than Goldman Sachs, a more well-known brand than Goldman Sachs. You start thinking, maybe I can do this myself. And guess what? There's been a couple of successes. So why wouldn't more do it? Now, it's not going to be for everyone, because not everyone has that brand, but some will.
Like Spotify did it, and they were successful.
Yeah. Well, they have a huge retail user base, and now you have retail on-ramps that can buy into the IPO through Robinhood and similar accounts. So yeah, I think you'll see it more often. I think that IPO market's going to fundamentally change, but it won't be everyone. It'll be the few firms lucky enough to have that big populist support.
And when are they typically announced to give the investors a heads up to call their broker or go into their Robinhood account if they're interested in a company that's about to list?
So they'll enter into what's called a quiet period, and that'll be publicly announced because they file documentation with the SEC, given their indication to go public. So there'll be a quiet period where that'll happen, and then generally, there'll be a roadshow,
and then with a direct listing, the public will get in the brokerage firm that they work with will indicate generally like less than a week before the IPO, and then people will put in for they'll put in what they want to buy. You don't always get that. You may get taken down in your allocation because there's so much demand for the IPO. So you may say, I want to buy $1,000, we don't get allocated 100 or 500. Okay. But that process would happen over the couple of days prior to the IPO itself.
So if it's a direct to market so if it's a direct one, They'll announce it a couple days before on CNBC or something?
Well, you'll know before it's going to be direct or not.
Like how much?
You'll know. Oh no, I mean you'll know like when they go into the quiet period, because you'll know that they made this decision to not hire an underwriter and not do an underwritten listing. So you'll know weeks or months before.
Okay.
Yeah,
so
then you'll get a heads up when it actually lists a couple of days before.
Okay, so then that way you can call your broker if you're interested in something and say, hey, at 9:30.
Yeah.
Go ahead and
buy. It's called an indication. I'm indicating I want this much exposure, and then you'll get what you get. You'll get based on, your broker's capacity. Your broker has to dole it out with all their clients, and so it's not purely egalitarian. It's not purely fair. The folks who pay more fees are going to get more of the allocation, but it's more egalitarian than the other way of doing it.
Interesting. Okay. So no, this has been really, really good. I'm trying to think of any other questions I want to add before we go out. But yeah, John D'Agostino, he's look him up. I didn't even, well, you were on episode 90, but if you haven't listened to episode 90, he's an American businessman, entrepreneur. He was also one of the founders or creators of the Dubai oil exchange. He's also the subject of the book Rigged. So go check that out if you can. But yeah, anything you'd like to add before we get out of here?
No, just everybody, have fun, be safe. Don't put yourself in a bad financial position, and understand that things don't happen linearly forever. That's not to say that assets like Bitcoin and others that are doing great right now, I'm not saying they're bad assets. They might be great assets, but there will be volatility. And so just don't fall for the hot hand fallacy, and just size your positions accordingly. And think about the downside. Really think about the downside and what you're comfortable tolerating. And if you really don't care if you lose everything, man, God bless. You're adults. Go do it. But what makes me sad is smart individuals who get caught up in the furor and lose sight of their risk tolerance. And I just don't want that to happen to anybody else. But that would happen to that Robinhood kid is just horrifying. And some of the stories you're seeing on Reddit now has a thread called GME loss porn, and it's basically just people like telling these heartbreaking stories about losing everything in GameStop. So just be careful.
Yeah, don't invest what you can't lose, especially when you're going after those meme stocks. And even if you're not like an accredited investor, there's advisors that can kind of help you out to more safely do it.
And then the last thing I want to leave your group with is if you really don't want to change the world, go after the hedge funds. That's fine. I don't care. But like if you really want to put that power behind doing something, knocking out every hedge fund in the world won't change a fucking thing. Like do something positive with that. Like go pool your money and buy student debt. Go bail out individuals so they can vote. Like do something. There's so many more positive ways that can actually go move your money from a bank to a credit union if you really want to take down the banks. I'm not saying that's a good idea, but that would actually have an effect on something. The notion that like knocking out a hedge fund with pension fund investors is going to like change the world in any substantive way. It's just not going to. There's better ways to use your money.
Okay. Very well said. Okay. Well, thank you so much. And you guys, thank you so much for listening to another episode of Next to Madison. We'll see you guys next time to find out who's next. Hey, your host here, Madison Malloy. Please make sure to subscribe to the show on all podcast platforms, and please rate and review us on iTunes and Spotify. Also, if you have any questions or comments, you can email us at contact@nexttomadison.com. I thank you again for listening. Bye.